Heart Ministry. I'm Laurie McFarland. Thanks for spending a bit of your time with us today. Well, many of you may have not known that I am a CPA. So what I want to talk about today is a little bit of a deviation from what we normally talk about here at Cross My Heart. But it is tax time. It is a new year. So a couple of friends suggested that I make some tax tips a good topic for a Martha Monday. It's a new year. It's January. And that also means that it is tax season, a season that just the word taxes can bring on a headache for many people. It can bring on no small degree of anxiety or concern or confusion. So today, I'm going to share 10 tax tips, and I'm going to try to make this of general interest. I'm not going to go into a lot of depth. Some of these may be things that you're already doing, and I just want to preface everything by saying that I'll always advise you to seek out your own tax advisor. Everybody's situation is a little different. These are just intended to be general information, things for you to think about, especially if you are beginning to think about doing your own taxes, or maybe you're a young person and you're going to be starting to file taxes even for the first time. So I've got 10 tips. The first few just sort of apply to everybody, and then I'm going to wrap up with 2 or 3 that apply to you if you're launching a home-based business or a small business. Anything more technical than that is just going to be beyond the scope of what we have time to cover here. So let me just jump right in. First of all, I want to remind us when it comes to taxes that our Lord Jesus actually spoke on that, and that may surprise you. Over in Matthew 22:21, our Lord Jesus said this: "Give to Caesar what is Caesar, and give to God what is God's." And that's good advice. Jesus didn't purport rising up against Rome, not paying your taxes. He said, if it's Caesar's, pay your taxes. Be a good citizen. And I think that's good advice for us living all these years later. I would say don't rob from your father to pay your uncle. We live in a country where, with our income taxes, paying our taxes yields a tax deduction. And so there's even a benefit from being generous. And so as we lower our tax rate, then as we lower our taxes, by taking that deduction for our gifts and our charitable giving, that decreases the taxes we pay to our Uncle Sam and maybe leaves more for us to give to our father. I heard a story several years ago about a man that couldn't sleep. He was feeling so guilty about his taxes that he had kind of cheated on. And so he finally just got up in the middle of the night and wrote a check to the IRS and sent it off with this note: I'm sending this, and if I still can't sleep, I'll send another check later. Well, the great thing about being honest and keeping good records is you never have to lose sleep about it. And as followers of Jesus Christ, we should be about doing the honorable thing and doing the honest thing. And so we never have to lose sleep at night. We never have to worry about it. We just do what is right, and then we can sleep in peace, right? So here we go. Let's jump in with my top 10 tips for tax season. And number 1 still is kind of on that spiritual dimension, and that is, I just want to remind my fellow believers, and I'm assuming if you've tuned into Cross My Heart that you love Jesus, tithing is not legalism. In fact, tithing is an act of love. It's an act of obedience, and if you have an obedience problem, really it's a love problem. Because we love God, we will tithe. And the Old Testament tithe is considered to be 10%. Many teachers this side of the cross and preachers would say that 10% is just sort of a rule of thumb. It all belongs to God, and so we decide how much we're going to give back to Him. I love what Letourneau, the president of Letourneau University, said. I heard this quote from him many years ago: "It's not about how much of my money I'm going to give to God, but about how much of God's money I'm going to keep for myself." And you know, that kind of an attitude comes from a heart of gratefulness and a heart of thankfulness. And when we really stop and ponder, all we have is a gift from God. The job that you have, yes, you work hard for that job, but the ability to get that job, the education to qualify for the job, the opportunity to interview, the paying for your education, all of that, it all was just an act of grace. It all comes from God. And so once we come to the place that we realize that all we have comes from Him, then it becomes a joyful act of obedience and love to contribute to His work and to use it to bless others. Money is just a tool. And as we tithe and as we use a part of what God has given us to bless others, I believe that blessing will come back to us. So number one is just to be generous and to acknowledge that tithing is love and not legalism. Number two, and I'm going to get more practical now, I promise, and get away from some of my spiritual teaching. Number two is don't forget those non-cash contributions. I know that when we write a check to a ministry or to our church, that's usually documented with a check, or if you give online, you'll get a receipt. You've got it in your records. The ministry or the church will send you a receipt at the end of the year. And so all that you can hold on to. But what about the non-cash contributions? What about mileage? And if you're serving in a leadership capacity, or if you're donating gently used items or items that are still in good shape to Goodwill or the Salvation Army or to your church ministry, any of those non-cash contributions, if you buy items to be given away to be used, or if you clean out your closets and there are things that you don't need anymore but they're in good shape, you can make an itemized list of those things and use sort of a thrift shop price to document the estimated fair market value. And so when I clean out and declutter and I'm hauling things off to the Salvation Army, I make an itemized list of those things, and the IRS has a little form that you'll need to complete for those contributions. And there are some forms. Several places online offer those that you can download. I'll add a link in the show notes below for one form that you can download where you can document your giving, the date that you gave it. Sometimes they want to know the date you purchased it, the date you gave it, the condition of it, that kind of thing. I just sort of use a thrift shop or a garage sale price. So if I bought a pair of slacks for $30 and I would probably sell those for $3 or $4, maybe I'll use that for the price. They're still in good shape. So don't forget to document those. That can add up if you've been doing some cleaning out. And then the second thing is your charitable mileage. If you serve in a leadership capacity, not just going to attend church, that's not charitable giving. But if you serve on a board or a committee, if you have to travel and you incur mileage, or you incur even a plane trip, if you serve on the board of a major organization and you need to travel to serve on that board, then those travel expenses can be deductible. So don't forget, as you document your giving, it's not just the cash giving, but there can be some non-cash giving. So that's number two. Don't overlook those non-cash contributions. And then number three, the charitable mileage in the travel. So the gift of items, or even items that you purchase to be used, but then also the charitable mileage in travel, number three. And the mileage is 14 cents per mile in both 2021 and 2022. You don't get as big a deduction for charitable mileage as you do for business mileage, but it can add up. If you're doing a lot of volunteer work and you're traveling in, or you're traveling a long way to do that, don't overlook keeping that log. It can add up significantly. Number four, keep a tax file year-round to collect all of these different receipts and all these different things that you're doing. And so I have a little, I call it sort of my perpetual tax file. It's just a hanging file folder. I have hanging files in my office where I keep up with statements that come in and receipts. And I have one just marked income tax. And so during the year, if I've made a donation to Goodwill or the Salvation Army, I have my itemized list. And then when I go, I ask for a receipt. I staple their receipt to my itemized list, and I just drop it in this file. So I never have to look for it come tax season. It all is accumulated here in one place. And then if I make purchases to give away, or if I make business purchases, I keep those receipts in my income tax file. They're all accumulated here. If you, then at the end of the year, when you begin to receive all those documents that say, with the outside of the envelope, that say important tax documents enclosed, just drop them all in here rather than put them in a pile and have to sift through it, your W-2s, your 1099s, all those year-end statements. And that way, when you get ready to either prepare your own tax return or go to your tax return preparer, it's all right here accumulated in one place. So that's number four, keep a tax file year-round. Now, when you open this up at the end of the year and do your tax return, it all comes out, and then it will be empty again going into the new year. So when 2021 documents all come out, then I'm ready for 2022 to start accumulating receipts again for the new year. And so then after you prepare your tax return for 2021, I recommend getting a folder, something like this, with pockets, because you need to maintain these records. And so what you can do is put the copy of your tax return on one side, and then all your receipts, all your 1099s, all your documentation on the other. And then I usually just put a sticker on the outside with the year, so that I know if I'm going through this stack of these, I've got 2021, 2020, 2019, and there you go. That way, if there's ever any question, in the unlikely event that you would be audited, because I doubt that you will be, but then all your records are all together in one place. Your mileage logs, all your receipts, your 1099s, everything here nice and tidy for you to pull out those records. And so maintain that yearly file with documentation on all of your tax return copies, all in one place. Now, I get asked many times, how long do I need to keep that stuff? The IRS will go back and audit for 3 years. So definitely you want to keep all of your documentation for 3 years. Now, they add a caveat that if there's fraud involved, they can actually go back 7 years. But if it's unlikely that you'll be audited, I highly doubt that any of my viewers are committing fraud or are worried about that. 3 years should be adequate. And certainly you want to be sure you don't just drop those things into the recycle bin. You want to be sure that they're shredded and all your personal information is protected. So you want to keep a current file, number 4, and then you want to maintain that annual file with your documentation for a minimum of 3 years. Number 6, just a tip as you launch into 2022. Some of these tips are going to be really for the new year, because preparing your 2021 taxes, you can't sort of go back and recreate things after the fact, but just a couple of little ideas. If your employer offers a flexible spending account or a health savings account, I want to encourage you to participate in that. I know people that just say, oh, I don't mess with that. But if you're in a 20% tax bracket or a 30% tax bracket, and you can squirrel away a few $100s into that account, then what that means is you can pay for dependent care expenses through a flexible spending account, or medical expenses with after-tax dollars instead of before-tax dollars. And the more money you make, the higher your incremental tax rate, and that can really add up. So how you determine your tax savings is this. The tax rates for income tax rates for federal vary significantly depending upon whether you're single or you're married or you're head of household, but the range is about 10 to 37%, and of course they go up. So it's not, if you're in a 30% tax bracket, that doesn't mean that all of your money is taxed at 30%, but just your last dollar, because we have this progressive tax system in our country. So the first amount might be taxed at one rate, and then the next amount at another, and so on. But just for general conversation here, and just to try to make it simple, I'm just going to say 30%. Now, there's not an exact 30%, but let's just say, since the rates vary from 10 to 37, let's just use 30 as an even round number. So if you're in a 30% tax bracket and you make a $100 contribution, or you have a $100 expense to deduct, in a 30% tax bracket, that would save you $30. So if you contribute $1,000 to your flexible spending account, and you're going to use that $1,000 to pay for dependent care benefits or to pay for medical expenses, then that 30% would save you $300. So instead of using your money after taxes, $700 to make your medical expenses, now you've got the $1,000, because that amount is sheltered. You'll have to go online to irs.gov or check the information provided by your employer to determine all the types of expenses that qualify for reimbursement. Often your employer will give you a flexible spending card, and so even when you go and buy prescriptions or pay for the doctor visits, you can use that card. It sort of looks like a charge card, and you can just tap into that flexible spending account to pay your co-pays, or your co-pays for the doctor doctor visit, the copays for your prescription drugs, and other expenses that are covered. But it can really add up to a significant amount of savings. So if your employer offers that, definitely take advantage of it. Now, one little caveat on the flexible spending account compared to the health savings account, it doesn't carry over. So that means that you just sort of have to use it or you have to lose it. So if you get to the end of the year, you want to sort of estimate on the front end how much flexible spending you can actually use, sort of estimate how many times you think you'll go to the doctor or get your teeth cleaned, or if you have prescriptions that you can estimate, add up what all those will be, and then set your monthly or per pay period contributions to your flexible spending account accordingly. Now, if you get to the end of the year and you haven't used up all that money, you can always maybe go buy some eyeglasses or something like that that's a little discretionary but still medical related. The other thing not to overlook is medical mileage. Medical mileage is deductible, and that's something that sometimes people overlook when it comes time to completing the flexible spending. So it's not just the cash you put out. So you have to, again, keep a little log where you went, submit that to your employer, and they will have some sort of a mechanism to reimburse you for that. So don't leave that on the table. If that's a benefit that your employer offers, then talk to your human resources person about how you can participate in that flexible spending account or the health savings account if they offer that. Okay, so we've talked about flexible spending. That's number 6. And so the last item that I want to share for just general taxpayers, number 7, is to itemize every other year. Now, that may sound a little strange. I've got some visual aids here to sort of help us understand what I'm talking about. So when you prepare to do your taxes, you add up all of your income, your wages, your interest, your dividends, any business income, and so you get to the total that your adjusted gross income. The government lets us have a standard deduction, or we can take itemized deductions, and those may be terms that you're familiar with. The standard deduction increased significantly a few years ago, and so now most of us add up all of our itemized deductions, and then we weigh it. We look at what the government's going to automatically give us as a standard deduction, and if it's higher, we take that, but if not, we take the itemized deductions. The itemized deductions are all laid out on Schedule A, and that's where you would include things like medical expenses after meeting they're only deductible up to after you deduct a certain floor, the amount to a certain extent. You can't deduct all of them, but that's where you would find property taxes, mortgage interest deductions, charitable contributions, and so forth. So I've got a little visual aid here that I'm going to sort of hold up, and hopefully this will make a little sense. I'm going to try to keep it in the screen. So for example, the 2022 married filing joint standard deduction is $25,900. So you will be able to deduct from your total income $25,900 no matter what, whether you tithed or had a mortgage to deduct or anything like that. If you're in a 30% tax bracket, then that $25,900 married filing joint standard deduction saves you $7,770 in taxes. Now, let's assume, and these are your choice, you do take the standard, you take the itemized. So let's just make up some numbers. Let's assume that you have property taxes of $5,000, you have state income taxes of $5,000, you have mortgage interest of $10,000, you have charitable giving of $10,000. I've made this nice even round numbers just for discussion purposes. You add all these up, and it comes to $30,000. And so you look at the $30,000 itemized, you look at the $25,900 they're going to automatically give you for standard, and you realize, okay, I am better off to itemize. And 30% of my $30,000 means I'm going to save $9,000 in taxes, and that is certainly better than $7,770. So in this year, itemizing would generate an additional $1,230 in tax savings for you. Money in your pocket. Yay, right? Well, what I want to suggest is a little way that you can take advantage of that high standard deduction and sort of leapfrog idea, so that you're going to itemize one year, take the standard the next year, itemize the next year. Here's how it's going to work. Now, I'm sort of comparing 2022 and 2023. I'm keeping everything just kind of the same, keeping it real simple. I know that the numbers, for example, mortgage interest is very unlikely it's going to be the same, but I just don't want to have too many variables here for you to understand the concept. So property taxes will be the same. You see, you don't get to choose. You still have to make your mortgage payment. You still have to pay your property taxes. So there's not a lot of itemized deductions that are discretionary. So property taxes, state income taxes, mortgage interest, those all have to be paid no matter what. So we're going to pay those. Then comes charitable giving. Now, as followers of Jesus Christ, we don't want to hold out on our church. Those missionaries that we support are counting on us. The ministries that we support are counting on us. So what I would recommend if you want to start this method is go ahead and make your $10,000 charitable giving this year just as you normally would, writing those monthly tithe checks. But then, and again, this is only going to work if you are financially in a position to be able to do this. So this isn't going to work for everybody. Everybody's tax situation is very different, but if you've got the cash flow to be able to do this, it's going to save you some tax dollars. So let's say if your tithe every year needs to be $10,000, you're going to go ahead and prepay your 2023 charitable giving at the end of 2022. You're paying for 2023, so you're going to pay an extra $10,000 at the end of the year. And so now, look what that's done. It has expanded, blown up your itemized deductions to $40,000. Your cash contributions here in 2023, then you will only have itemized deductions of $20,000. So because you pulled the charitable giving from 2023 into 2022. So that means this year in 2022, you're definitely going to itemize. In 2023, you're not going to have enough to make itemized work. So you're just going to take the standard deduction and get the full amount of $25,900. And so we're going to every other year take advantage of that very generous standard deduction we have now. So in 2022, when we itemize, that's going to generate, if you're in a 30% tax bracket, $12,000 in tax savings. This, and then the next year, we'll take the standard deduction, get that same $7,770, and then when we combine these two, itemizing in 2022, taking the standard in 2023, our 2-year total tax savings in our 30% tax bracket is $19,770. Whereas if you, so that's an additional $1,770 in our pocket over what it would have been if we just stuck with the regular way of itemizing and just taking the numbers when they normally would go there. So anyway, I hope that if you take a minute to wrap your mind around that and work the numbers, and again, your situation may be completely different. If you've paid off your mortgage, if you're in a state that doesn't have state income taxes, you can still deduct a portion of the sales taxes. There's a little table you can use, but it might just be something to push some numbers around, talk to your CPA about, look at your own tax situation. But that is number 7, to take a look at whether itemizing every other year would make sense for you. And again, I recommend always prepaying. I never would want you to hold back on your tithe or hold back on your giving and then pay it all in January. It only works if you pay in advance, because those ministries in your church are counting on you. You're probably also, if you do this, you're going to need to communicate and let them know, I'm not giving you a big bonus, I'm just prepaying my support for the next year, because they don't want to suddenly think that their ministry budget has been expanded. Okay, so enough of that. So numbers 1 through 7, just reviewing briefly. Tithing is love, not legalism, so just can't encourage you enough to walk that out, figure out what that's going to look like. Number 2, don't overlook the non-cash contributions. Number 3, record your charitable mileage and travel, take those. Number 4, keep a tax file. You've got to hold on to all those receipts. Number 5, maintain a yearly file with documentation in your tax return copies should you be audited, or just even to review last year's when you're preparing this year's. always a good idea to make sure you're not overlooking something or there's not a missing 1099, just to scan last year's to this year's as a way to ensure you haven't forgotten something before you file. Number 6, look to see if your employer offers an FSA. Consider doing a flexible spending account or a health savings account. Number 7, consider whether itemizing every other year might work for you. Okay, number 8, 9, and 10 are all for you if you have a small business. Now, if you have launched a little cottage business or you do a little consulting on the side, maybe you are doing a home-based sort of Pampered Chef or Mary Martha or one of those types of businesses, this is probably what I'm talking about. If you have a business with employees or you have a manufacturing operation, you own some sort of a business, I'm sure that if you own your own business, you already have some systems in place. You may have a bookkeeper or a CPA that helps you out. So these next 3 little business ideas, business deduction ideas, maintaining tax records for a small business are really for you if you're just starting a business or have a little home-based business. And so the first, number 8, is to keep all business receipts. You absolutely have to hold on to those. Now you may think, oh, it was just a few dollars. It was just a little bit of postage. It was just a little bit of this or that. Well, as your business grows, it may grow to be significantly more than that. And every expense that you incur, and just throw some cash at it and don't keep it a receipt, is money that you're giving away. If you're in, again, I just use 30% as a nice even number. If you lose $100 in deductions this year, and that's 30% loss, that's $30. And we haven't even gotten to talk about self-employment tax yet. That's sort of the Social Security for a self-employed person. So again, that's going to be beyond the scope of our conversation, but it can be significant. And as your business grows, and if you're in business, certainly you hope it grows. So in the years to come, it's just good if you have good practices in place now to set you up to keep those records and develop good habits while your business is small, so that as it grows, you have some systems in place. Now, if your business blows up, you may want to invest in Quicken or some sort of a software package. You may have to hire a bookkeeper, but while you're small potatoes and just starting out, if you want to keep it simple, I recommend just using the good old manila envelope. Keep this thing handy, and maybe you're just going to get 12 of them, and this will be your January 2022 receipt file. If you go to the post office to mail something, you're going to get that receipt and throw it in here. If you go to Walmart and you buy some business supplies as well as milk and bread, you might just want to check out twice. Divide it up. Check out with your personal stuff, get a separate receipt, and check out with all your business supplies. Stick it in here. If there's a business meal that you have to do whatever, if you incur some office expenses to print some business cards, keep that receipt, stick it in here. And so just having all the receipts accumulated in one place, even if you're not going to the expense of having a dedicated bank account or a separate checking account, and you just feel like you're small enough, you can just keep it in your own checking account and use your own same charge card. Have a system that you keep track of it so that those receipts are captured. I recommend that you even consider having a dedicated bank account if you get big enough, or at least a dedicated charge card. That's number 9. Consider a dedicated bank account or charge card. Now, I know that a bank account can get to be expensive with those monthly charges, so if you do maintain it just with your own personal bank account, use your own debit card or write a check, but have some footprint rather than just paying cash, so that you're going to be more likely to grab a hold of it. We all get offers every day in the mail to get yet another charge card. So another idea that might be easy is just to dedicate one of your charge cards just for business, even if it's not in the business name. That way you know that you're just going to always use that charge card, and then those 12 monthly statements can be a good check against all the receipts that you have in your folder to make sure that you haven't missed any expenses, and it'll make that easy then to add them all up take your 12 envelopes, take your 12 statements. You've got it all to add up at the end of the year to be sure that you're not missing out on anything, because it's not just the 30% income tax, it's the 15+% self-employment tax. If you're in a state that has state income tax, it can really get to be significant. So develop some good habits now to track and hold on to all those receipts and keep track of everything. And then number 10 is to log your business mileage. Mileage can be just so significant, and I know a lot of folks are just so intimidated by it. They leave a lot of business expenses on the table because they're fearful of being audited or not keeping good records. Just log your odometer at the beginning and the end of the year at a minimum. And again, there's tons of apps out there that you can put on your phone. There's lots of logs. If you just Google IRS mileage log, there's tons of forms that you can download for free to keep track of it. You can put the information on the outside of this envelope. Just what you want to do is, the IRS requires a contemporaneous log. You can't just get to the end of the year and guesstimate, oh, I think I drove 1,000 miles for business, or I think I drove 100 miles for business. You need to document it. You need to keep track of it contemporaneously. The date, where you went, what the business purpose was, and keep track of that mileage. If you just jot that information on just a small paper calendar that you keep in your car, and then if you want to transfer the information into a spreadsheet, making it easy to add it up, and add up it will. The standard mileage rate for 2022 for business purposes is 58.5 cents a mile. Now you start adding that up, and you're going to see very quickly what that will do to help on your tax return come next year. You just need to keep adequate records, and keeping a little log, you just get into the habit of doing it, and it will save you a whole bunch of money. Well, I hope that some of this has been helpful. I know it's been just a real general overview with a few little tax tips. Again, just to issue that disclaimer, everybody's situation is different. You'll need to consult with your tax advisor. You'll need to look at your own personal tax situation. But taxes, you know, what is it they say, that the only thing certain is death and taxes? Well, taxes don't have to be the death of us. It's black and white. There are just rules to follow. It doesn't have to be anything scary. But what I just want to do, and I know that you want to do as well, is to be honest, to walk in integrity, and to be a good steward of all that we have. We'll add a link below for a download that you can print with my top 10 tax tips, and I hope that maybe one of these might be helpful to you. Well, good luck. I recommend just getting it done and filing early and having it over with, sort of like ripping off the Band-Aid. So whatever you do with your taxes, just keep good records and hold on to all those receipts. Thanks for spending this time with me. For Cross From Heart Ministry, I'm Laurie McFarland.